Welcome back to another episode of Inside Canadian Real Estate. Today I'm here with my friend Jack Kerr. He's a mortgage broker, mortgage expert over at Donaldson Capital. Donaldson Capital is an incredible family-run firm, a boutique firm specializing in luxury properties and cottages, construction financing, but they also handle all your traditional financing needs as well. They're well connected with A lenders, B lenders, private lenders. They got the whole bit. And today we're just talking about all of it. We're going to be talking about interest rates. We're going to be talking about mortgaging options. If when I just gave out all those options of A, B, and C lenders, maybe you're like, what the heck does that mean? We'll talk about all that today. So if you're interested at all in financing real estate or the options available for different kinds of projects, whether for your home or for your build, that's going to come up today. So without further ado, let's get to the show. Thanks for coming, man. Mm-hmm. Thanks, buddy. I appreciate you coming down. I know it's a little bit of a drive, but not too bad.
No, not too bad at all.
But today we're going to talk about a bunch of fun stuff. But before we do that, why don't I have you introduce yourself so everyone knows who we're talking to here today?
Yeah, Jack Kerr, Donaldson Capital, mortgage broker. I actually just completed my broker's license, so I'll be switching my actual license to broker.
Nice.
It's exciting.
Congrats.
Been in the business for 3 years. Recently made the transition to Donaldson Capital, and we have a focus on high net worth individuals. And then, of course, a lot of my clientele are in the first-time buyers, investors, first-time and matured investors. And then we dabble in, the high net worth clients. Not dabble, that's our main focus.
Right.
Yeah.
I love that. But, man, I mean, that segues me perfectly into, like, what the heck is going on with mortgages and interest rates, man?
You and me both.
Holy cow.
It's a daily change, as you, I'm sure, see all the time. There's so much news around it, and conversations kind of are focused on interest rates right now in the market and what's happening.
Yeah.
And over the last couple of years, we've seen rates come to historic highs, and they've stayed there for a bit, and it's very interesting.
Yeah, it's wild. I mean, so you mentioned like at Donaldson Capital, which seems to be a really solid spot. I mean, I've looked into you guys quite a bit. We're probably going to use you on a project like I mentioned. We've been going back and forth with that.
Yep.
You guys do have some unique products and some unique experience, especially with that market, and we'll talk about that in a bit. But you mentioned you focus a lot on high net worth clients. So let's talk for a second, like broadly. We're talking rates and mortgages. Do you see that high net worth segment of the market being affected as much, more or less than like the general public is feeling rates right now?
They're not as affected as higher interest rates yield, of course, a little bit lesser purchase prices. There's also more opportunities. So with the capital that they have, they're able to make moves in this type of market where others aren't. Yeah. And again, those interest rates, they realize that are temporary. Yeah. Where the first-time buyer, for example, that only has that certain qualification that they can purchase at, it's much harder for them. Where high net worth, someone that's sitting on a lot of capital, a lot of investments, is able to move their money and allocate it accordingly.
Right. Yeah. I mean, if you're down to your last 10 grand, you lose half. You're at 5. You're in a painful spot. But if you're at your 50 million and you're down 25, you still got 25. Yeah. So it helps. I mean, the only thing I think of that I always would wonder, like with the high net worth, is like they also though are involved in a lot more stuff. Like if they have that high end cottage, they have that nice home, maybe they have that vacation place in Florida. Yep. Like I was always wondering, do they maybe still feel it pretty badly if they're affected across the board, or are they still pretty insulated?
Yeah, so someone that has a larger portfolio, or if they're in variable rates, they've definitely felt that heat over the last couple of years of rates rising. So yeah, they're definitely not immune to it by any means. They just have the means to be able to afford it, or at least weather the storm a little bit better. Right. Where someone that had a variable rate in 2020 or 2021, and now they're sitting at double or 3 times what they were then, they're a lot more affected if they have limited ways to afford that home or multiple properties if it's an investor. Totally.
That makes sense. So for the general public, like let's again, I want to stay broad a little bit first, and then we'll go deep. But if we can talk about just mortgages right now, general public, your home, your primary residence, what are we looking at right now, roughly? I know it depends on the lender and the bank, but what are we looking at right now in the range of rates for your average, excellent credit score, I'm buying a house, or I'm doing a refi? Like, what's that scenario looking like right now in terms of rates?
Yeah, so if you're purchasing a home underneath $1 million, you can get an insured mortgage at roughly like 5.84%. It's not terrible. And then if you're refinancing your primary residence into a new 30-year AM, 5-year fix, you're roughly 6.4, like 3%, 6.4%, in and around there.
Interesting. Why is the refi higher?
Because you're a 30-year AM, so it's uninsured. Right. It's a conventional mortgage, so there's no CMHC or Genworth or Canada Guarantee Insurance backing it.
Gotcha.
So the lenders take more risk, so in turn they, of course, charge a higher premium on that rate.
Gotcha. Now, are we still seeing, like, the math is weird because I'm seeing people buy houses still.
Yep.
Like our neighbor across the street just moved in. They bought 2-3 months ago, almost 1.9 million. And I'm trying to do the numbers in my head. What kind of income you need to get approved at, 30% down, let's say on 1.9 million. The numbers seem kind of crazy. Like the income you need, like, is there ways around this? Is there some sort of strategy people are using to get into this, or is everyone like a lot more rich than I expected?
Yeah, it's a great question. It's tough. You're right. Like the income that you need in a dual income scenario, like $250K annually to afford something like that. I mean, I don't see a lot of people. I mean, we do see a lot of people making that money, but the average income in Canada isn't that high.
That's the thing. Like, I always wonder how they're doing these $2 million deals with the interest rates we're at. When they don't look. I mean, obviously, if they're like business owners and they're super well off, and that's different. But I'm talking about like, I'm seeing regular people with regular jobs buying these crazy. Like, I mean, do you see a lot of people rolling equity? Is that where we're at? Like, they sold their place and they're kind of rolling a lot of that into the new place to kind of ease the burden a little bit on the finance side?
Yep, they are. But a lot of people kind of cap their equity on, like, in previous low interest rate times, they refinance. So there is some people that are even selling and they're not getting a lot of equity out of their home because maybe their mortgage was maxed out at 80% loan to value.
Right.
There's different scenarios there. But if someone did have a very low equity position mortgage on a house and they're selling and now they can go into a bigger home and put a large down payment down, if they're underneath that 65% loan to value on a property, there's quite a few lenders that we can utilize that will extend ratios for clients. Also, alternative lenders, sometimes known as B lenders, have different programs, especially with self-employed. We can use business income to help qualify them versus what they're showing on their T1 Generals or if they're T4'd. So that can bring a higher yield of an income to be able to qualify them, right?
Interesting.
So there's different ways to structure it. We're also seeing multi-generational purchases, right, where people are having additional co-signers coming
in. Their parents.
Yeah, or some income. Maybe there's an income suite in the basement, helps out with qualifying, right?
Yeah, and that's what I always think of that too. Like when people say, like the people that say the market's going to come down, I'm like, people will just put more families in a house before we start seeing those. Like before demand disappears in the market, you'll just see more people under one roof. That's what's going to happen, and it's going to drive the prices up, I think, even more.
We're already seeing that a lot.
100%. I just see it walking around, like just looking on our street, you see it. So it's definitely happening. Now, for the average family, like a big hot ticket issue right now is like, I'm in a house, I'm on a variable rate. I bet on a variable rate. And now I've heard different things from different people depending on their lender, but I'm hearing these different stories of what's happening. Some people are saying my mortgage is going up. It's going up every month or it's going up every whatever. Some are up for renewal. Oh my God, it jumped. Some of them are saying, no, it hasn't gone up, but just my amortization. Can you, if you can, but like speak to that? Cause I actually want to know for myself, like clarity on like what is exactly going on there with people's mortgages that are supposed to be climbing? Why are some climbing? Why are some not? What are the options banks are giving these clients right now? Like, why is it different across the board? I'm just interested in hearing about that because I'm trying to figure it out myself.
Yeah, like specifically on a variable rate, you mean? Where a variable rate has gone up, but their payment hasn't necessarily gone up?
Exactly. Yeah.
So there is certain lenders in the space at the bank and as well in the broker channel that work on kind of it's called a static variable. And what happens there is your payment stays the same, but the interest and principal changes. So as rates go up, the amount of principal you're paying every month goes down and the amount of interest goes up. Now at a certain point when interest rates get to it's called their trigger rate, that's when you do have an option and they send you usually a letter or call you and tell you that you have to increase your payments in order to pay some principal because as of this point you're just paying interest only.
Right.
And then that's where you get into these extended amortizations, which you've seen in the news, where it's showing 40 or 50 years amortized on mortgages, which really isn't allowed on residential mortgages through OFC. So there's some stuff that they're doing in the back end to try and figure out how to do that. But that's where they ran into trouble is on these static variable rate mortgages, where your payment doesn't change as variable rates go up.
Right. That makes sense. Yeah. Because that's what I've been hearing from a lot of people was that they're on variable and for some reason their payment didn't go up for a while. Yep. But now it is. So they basically hit that max amortization. Yep. It's all interest, which kind of sucks because you're basically paying rent. You're renting 100%. Money. That's what you're doing.
Yeah. I mean, you own the home at the end of the day. So if you needed to sell it, you're still going to get some equity out of it. But
hopefully.
But you're not paying any principal off.
Yeah.
You're right. Hopefully.
And we're getting a lot of So, I'm in the business, like, yes, I'm a real estate agent, but also I'm in the investment side.
Yep.
And our family has a house flipping business. So
Yes.
we do a good volume of these deals. And a lot of our deals lately have been coming from people that that's happening to. So they've hit that cap of amortization. The payment's now climbing, but it's significant enough that they can't get out of it. They're just like, I can't make this payment. The problem is, the biggest issue we're seeing is we have those people come to us now, and we try to figure out, great, what do you need for your house to get out of it? They need more than the house is worth. And when you talk to them as why do you want that number? It's because that's what they owe. Maybe they've remortgaged, maybe whatever the case is, they bought at the wrong time.
Second mortgages.
They've burnt their equity, whatever it is exactly.
Yeah.
And they can't get out of that. Like, is that a problem you see a lot? And how do you kind of advise people to stay out of that? Like, how do you avoid doing that as a homeowner, getting that position where now you're totally screwed, you owe more than the house is worth, and you're stuck? How do you avoid that?
I mean, that's a really tough question. I mean, if you're in a situation where you have to tap into that equity for whatever you said, any of those reasons, I mean, a lot of people will do what they have to do to keep their house, right? I mean, of course, we advise not to do certain things, maybe not to get into risky second mortgage situations or third mortgage situations. Those can be very risky and high rates. So again, we just try and mitigate that, but there's a lot of people will just do what they need to do in order to save that house. So if they're seeing a decrease in cash flow because of whatever reason, and they need to add a second mortgage to be able to pay off debt, or just give them some cash flow to be able to pay the first mortgage, that's really, that's probably the worst thing that you can do, but people do it.
Ooh, getting a mortgage to pay the mortgage, that hurts.
Yeah.
So do you see, because I'm going to be judgy now, do you see more people doing it for smart reasons, coming in and saying, no, I actually do have something to pay, or I need the money? Or do you see discretionary, like, no reason, I just like, and this is more like when we were top of the market. I was imagining in my head, people are just going, well, I kind of wanted a new car and a new pool and a new thing and a new vacation. Like, do you see a lot of that, or is it more like legit reasons, like I actually need the money for bills?
Yeah, I see a lot of legit reasons. If it's someone that's just wishing to purchase new things, especially in this market, that we would not suggest doing that. I mean, like you said, when rates were low and people were taking money out of their house really to kind of fund a lifestyle, that happened more, or they were just taking equity out because rates were so low so they could, and it didn't affect their payment that much. So then they're sitting on cash, or they're buying toys and whatever, like the things you said. But yeah, these days we're seeing a lot of people that if they are doing refinances or second mortgages to help with cash flow for whatever reason, there is some type of plan there. To either pay out that mortgage either with a sale or maybe some other investments that are coming in, whatever the case may be.
It's like kind of a lifeline.
It is.
They're trying to buy time.
A lot of people use
they
their
get
house as a lifeline.
That makes sense. This is actually interesting, because I'm genuinely wondering this stuff, because I'm seeing all these different scenarios play out. I'm kind of wondering, why are people doing what they're doing, or how is it playing out? But it does seem like, and because you kind of answered my next question, because that's what I was going to ask, was like, it seems like a very bad idea to get a second mortgage to pay the first mortgage if you don't have a plan, because then if you get that second one and still can't make that payment, like, what are your options then? Like, is there a third mortgage to pay the second mortgage? Like, how do they get out of that?
Yeah, I mean, again, I don't work on a lot of those files. Those are pretty risky stuff. And again, it's tough to find lenders that would do that scenario, because maybe you're already behind on your first mortgage, or they can see that you're really strapped for cash. But most of the time when someone's doing a strategy like that, it would be a very clear exit. Maybe they're listing their house in the next 3 months to 6 months, so they need a little bit of cash to be able to pay some of their monthly bills, and then also take out some equity to maybe update the house, do some fixing around to be able to get top dollar. That would kind of be the only scenario that I would suggest doing that if you're already strapped for cash to begin with.
Makes sense.
If you were going to maybe sell that house.
Yeah, you have a plan. Yeah, I like that.
100%. Or some investors, if they have another equity position in another home, they're going to list that investment property.
Right. You have money coming back.
Yeah, you have money coming in.
I like that.
Yeah.
Let's cover, there's a few things I want to cover, because I feel like a lot of people have misconceptions on this too, but when it comes to getting a mortgage, it's not just a bank. A lot of people think it's just, I go to the bank for mortgage. There's a lot of options out there. I think that's one of the value propositions of why you work with a broker, and why I'd like to work with a broker typically. A lot of people ask me why have a broker, can pay their fees, but I don't think they understand that there's a benefit to not just going to your bank. Like if you're at CIBC and saying, hey, I need a mortgage, what can you give me? There's actually a benefit to shopping around, because there are options, and we've thrown around terms already, like A lenders, B lenders. Can you kind of talk about that landscape a little bit? Like, what kind of lenders are out there? How do we tier them? What do we need to know about that?
Yeah, I think the one thing I want to touch on there is the fact that working with a mortgage broker, a good broker should suggest that you always talk to your bank first, or at least at some point. because your bank, of course, they have your full portfolio. They know you as a borrower,
Right.
and they're going to offer you a specific rate. That's what you want to shop around on. So then you come to me as a broker and you say, hey, listen, my bank's offering me 6.2% on a new purchase, and I say, okay, well, let's see what we can do. So then we come up with a solution where we can offer 6%. So then
Nice.
that your bank's offering this and we're offering that, and you're getting the best solution out of that. So that puts, of course, you at ease knowing that you're getting the best option.
Right.
Because typically you'd think your bank would give you the best rate, but that's not always the case, and typically it's not.
Yeah.
And then you wanted to know kind of the differences between your tiers. So of course you have your prime lenders, your large banking institution. Those are known as your A banks. You have your monoline lenders that are built in there as well, which are your banks that just deal in mortgages, and they're usually accessed through the broker channel only. Some of those lenders would be MCAP, which is one of the largest mortgage companies in Canada. First National is well known.
Gotcha.
And then you have your B lenders, or alternative lenders, we like to call them, Equitable Bank, Home Trust. Those lenders, of course, they have extra appetite for extended ratios over and above that typical like 44%. And then you have your private lenders, which is like a C category. But again, some people use that private lenders as a tool to enter properties. Again, if you're an investor, private lenders can be a very lucrative asset to your portfolio.
And that's a channel that we've used a lot too, sure, as private lenders.
Yeah.
I'm curious, like from the broker side, so pretty much we have 3 tiers. We have our A lenders, it's our banks, and like you mentioned, like the First Nationals of the world as well.
Yep.
You have your B lenders and you have your private. When you guys are setting up like these relationships with private lenders, is that typically an actual individual that you've built a relationship with, or is there some way that's done at like an enterprise scale and there's this pool of private lenders you pull from?
I think a bit of both. As a good broker, you should always be building relationships with, like, again, high net worth individuals that want to lend their money on mortgages.
Right.
So those are found through your own center of influence, if you want to call it. And then just as you expand your business, you find these people that want to lend in mortgages. And then there, of course, is a wide range of private lenders that are registered. They have their mortgage administration license. They are mortgage investment corporations. And we go to them as brokers and bring them deals. They have typical appetites that they want to see with deals. So we know which ones to go to for specific properties.
Right.
I know we're going to work on a construction file. So that's only specific lenders have appetites for those. So you're not going to just shop that around to every lender.
Right.
You want to know which ones you can go to.
Right. No, that makes sense. And so when you're doing private lenders, like you mentioned, on the more like institutional side, those companies, are those, this might be too deep, but are those companies, because they're obviously raising capital themselves, so they're going to individuals pooling capital. Are they typically like private equity styled companies? Is that how they're doing that? And then you guys just borrowing from them?
Yeah, typically.
Interesting. And so like me though, as an individual, if I said, hey, Jack, I have $1 million I want to put out on mortgages. Yep. You could also broker directly with me. You could get my money working on a deal.
That's correct.
And I can kind of set the criteria of what I'm looking for, tell you what I'd be willing to do or not do. And it's just to me is I don't have to have any sort of special license or business to do that. It goes through you.
Yeah, that's correct.
Oh, that's
as long as you're considered a designated investor. So you just have to have a certain asset worth or income, and then you can lend your own money.
Do you know roughly what that is?
Your income has to be above $250K a year annually, 200 to 250K a year annually, or plus $2 million in assets, liquid assets.
Got it. And is that the same what if you're a corporation, like I own a business, I have some extra cash, I want to invest from there. Can it be done from there too?
Yes.
Oh, that's cool. And same criteria on the business, or it's based on the individual?
It's similar.
Oh, that's interesting.
Similar for the business.
Oh, that's very cool. Yeah. See, because that's not an option that I thought about a lot because we've been at low rates for so long. Yeah. But now that we're where we are, I think that's a viable option for a lot of people like that are higher net worth and they want a safe investment. Connecting with brokers like you guys and saying, hey, I want to put my money to work makes a lot of sense now because you're probably getting what, like 10% plus fees, that like around that
rates are always negotiable, and that dictates on the risk of the deal, right? And your appetite. But yeah, definitely first mortgage is usually 10 to 12, and then second mortgage is anywhere from 12 to 14%.
And how long, like what's the appetite for the typical private investor? Like how long do they want their money out for? Like they're obviously not doing 30-year mortgages.
No, like usually there's no amortization. It's interest only. So then your terms are usually 1 to 3 years max on the private side. I mean, some people even do 6 months. And then there's lenders that we work with that have open terms. So there's no prepayment at all. You can basically pay that mortgage out at any time, which is beneficial.
That's cool.
Yep.
That's neat. Yeah. So really the private lending is a tool like from the person getting it standpoint, it's a tool that's really just a bridge.
Yeah.
I'm going to, like we said before, I'm going to get something eventually, but I need this in the interim. So whether it's like construction or it's an investment property or it's whatever, that makes a lot of sense. You're getting it 12 months. And then once you get whatever you need to get, maybe you're doing a renovation, you're doing a build, you'd go back to a B or an A lender and refi out. Right?
That's correct.
Very cool. So tell me about Donaldson Capital. I want to hear kind of, you recently joined the team.
Yeah.
You're working with them now. Mm-hmm. What's different? What's special about him? Tell me about him.
So yeah, Drew Donaldson is the principal broker, and he's been in the business now close to 20 years. And he's created such a unique niche and been able to help so many people in the category of, again, high net worth, people looking to either purchase their second homes in Muskoka. So we focus on the Toronto and Muskoka area. And then there also is a factor there of your construction financing. So he specializes in construction financing. And again, we're a boutique brokerage. It's just three brokers, and yeah, it's very exciting. Very exciting.
That's very cool. Mm-hmm. So with everything that's been going on, like, are you guys still seeing a lot of movement in that? Like, how's Muskoka doing through all this? Like, are they just thriving still?
It's interesting, doing a lot of deals up there still, and there's stuff moving. It's an interesting market, that's for sure.
Yeah, because I was going to ask you, because I talked to a planner, I think through one of your referrals. Yes. I ended up talking to a planner.
Yeah.
And he's like, we're super busy right now. We're doing X number of deals, this many proposals. We're swamped. And I'm like, why are you guys swamped? Because in my head, I'm thinking everything's slowing down. Right. He's like, no. Everybody's building stuff right now.
Yeah.
That blew my mind, because I'm expecting the opposite. I'm expecting them to be slowing down. But they're doing a lot of construction, which means you guys should probably be also pretty busy on the construction financing side right now.
Yeah, that's correct.
Right? So that's probably keeping you pretty busy.
It is.
That's interesting. And they usually already have a primary residence, probably Toronto, the clients that you work with?
Yeah.
And this is their secondary.
Yeah, that's correct. Yeah. Drew's, again, he started in the Toronto market, so his clients have all, of course, grown up now. We're purchasing properties up in Muskoka. We do have an office in Port Carling, so we have a lot of realtors up there trust us with their clients. And then, of course, builders. We have a lot of builder relationships. So then when they have clients that are needing construction financing, as you can imagine, there's some people that don't necessarily need construction financing. They pull equity or something from their investments. There's different ways that they can do that, but yeah.
Interesting. Is there anything you guys do that's like super cool or different from like another broker? Like, if I had to say, here's something really different about you guys. I mean, you specialize obviously in the areas you mentioned, but I'm sure there's other brokers that do construction, other brokers that do Muskoka. Is there anything unique about what you guys are bringing or offering?
I think just our customized mortgage solution strategy, just how we look at portfolios as a whole, just kind of structuring deals the best that we can for that client. There's just something to be said about someone just coming to you for a construction deal and not looking at the rest of their portfolio to see if there's other ways to access that money without maybe doing a high interest construction deal. There's a lot to be said about that customized mortgage solutions and how we look at our clients and underwrite our deals.
Yeah, because that's the hardest. Anytime you're working with a lender, like I'll say from the client perspective, especially when it comes to doing things that are not conventional, like you're not just buying your house and financing it. You have to get the right broker. You have to get the right person, because like it's a lot of effort explaining. Like, certain people just don't get it. They've not been in those shoes. They don't understand the scenario. They don't really know what you're trying to convey. And I think having specialized expertise goes a long way, and having a process that can account for all the variables goes a long way. Because not every broker is created equally, and not every lender is created equally.
No,
and so I think that's huge. Like, that's why when I thought like this project we're doing in Bracebridge, like we're building that custom house, I thought of you right away, because I know you guys specialize in that. And it's a different conversation than if I go to, and of course, a lot of brokers will say, yeah, we can do construction financing, but they do like one a year. And it's not what they do. Like, and they think they understand, but they don't. You're trying to explain certain scenarios or certain timelines or certain needs, and it just doesn't make sense. So when you go to someone that's specialized, it goes a long way. And I think that makes, that right there makes it worth it. Like, trying to find someone that does what you do.
Yeah, and honing our craft too. Like, market changes all the time. Different
100%.
Lenders change their appetite all the time. So just knowing that, having the relationships, having the conversations. If you're doing construction deals once a year, that lender that you went to last time might not have an appetite for construction anymore. So if construction's always being done at your firm and with your broker, those conversations are always being had. Right. So those relationships are strong. We know which lenders we can take those deals to and get you the funds quickly.
Yeah.
There was something else that I thought of, but it kind of passed my mind.
Escaped your mind.
Yeah, it escaped.
Fair enough. My next kind of point I want to go on there too is like right now, like if you're giving sort of some guidance, like let's say there's some, because you focus on high net worth. I mean, obviously you probably can service anybody. I'm sure you guys do a lot.
I service all clients. Again, I've had people reach out and they're like, "Oh, do you only deal with high net worth clients?" Like I don't feel like I'm in that bracket. And it's like, well, no, absolutely not. Again, I'm from Barrie. I have a very unique situation where I have a large center of influence. So I have a lot of clients that I work with and a lot of friends that I work with, and whoever needs a mortgage and needs guidance, I'm there for. I think that's the biggest thing.
Gotcha.
But with like you said, those niches that especially Drew's been able to dial in on the high net worth, the construction, and then second home purchases, it just allows us to be the focus and the ones to go to for those needs.
Yeah, I love that. Yeah. So if we go general for a second, and then I want to go into your target market, but I want to get some advice. So on the general public side, I'm buying my first house, which is happening. There's debate on should I be, because a lot of people are like, maybe I'm going to wait, maybe I'm not going to wait, but nonetheless, I've decided to pull the trigger. I'm trying to get into a place in the next 3 to 6 months. What should I be thinking about? What steps should I be taking as an individual right now to make sure that I'm going to be able to secure that financing? I'm going to be in a good position. I'm going to get all my ducks in a row. What's my first step after I talk to my wife? I'm like, yeah, we're going to do it. We're going to buy a house. What am I doing next? Who should I be calling? What are we working through?
You got to get the right team. So there's a couple of things to be said there. Definitely the right mortgage broker. And then secondly, the right real estate agent. I think working with a realtor is ideal. I mean, going directly to a listing agent isn't always the best option because they, of course, have the sellers that they're working on behalf of. Right. At mind, and then of course yourself. So you can do that. You can go to the listing agent of a home that you like, or you can work with a trusted realtor that is going to work on your behalf. I think the one thing to be said right now, especially, is there is some deals to be had. I think actually more, there is. Yeah, I think there's actually more than we can actually see. A lot of stuff is on MLS. I know you do a lot of off-market stuff.
I do
on your family business, but there's a lot of properties on MLS, and there's a lot of deals to be had. So I think it is a good time to be looking for a house, or at least to get prepared. So of course, when you're working with a mortgage broker, knowing what you're pre-approved for, knowing what your max is, what your budget would be, and going off of that, and then working with a trusted realtor, I think you can definitely find a really good deal on a home right now.
Is there anything I should be considering as an individual, like if I'm an individual, that I want to line up with my finances ahead of time that I should be aware of? Like, for example, like, does it matter if I just got a new job last month? Maybe I just went off on my own and started a business. Like, is there anything that I should make sure I understand before I pursue that maybe would blacklist me? Like, hey, don't get a mortgage right now if this. Like, is there anything I should be worrying about?
Well, always kind of bring those conversations up. Again, every scenario is different, but you kind of brought up a couple. So if you're switching jobs, for example, if you go into a new position and you previously were at another position in the same industry, usually that's okay. We can use that income. They'll sometimes look at what you made in the last 2 years as a 2-year history. If you're just out of school, for example, and you just landed this new job, they'll look at what your guaranteed salary is. Usually they want to see like your last 2 pay stubs. If there is a probation period, we can mitigate that as well, but they'd want to know if there's a probation period, usually 3 months, 6 months. If it's government, sometimes there's a 12-month probation period. Wow. But there is lenders that we can work with that. We just need to know all those details up front. So sometimes your mortgage broker, especially on our side, we ask for documents up front, usually 2 pay stubs. If we can get a job letter from your employer just to see what they'll write on there, if there's a probation, what your salary is, and then again, those pay stubs to kind of match it. If you're going into self-employment and you previously, let's say you worked for an electrician company, and now you're going to open up your own business. Yeah. Usually we need 6 months to 12 months of bank statements. And that they do like to see 2 years of history for business owners. And then there's ways that we can gross that up on both the insured side and the uninsured side. But yeah, that's again, quite a lengthy conversation on 100%. That side. Yeah. But there is, again, every scenario can be worked with. I think that's the biggest thing to kind of know, that when you're a first-time buyer or a new buyer, whatever the case may be, that you just have to disclose all the information, talk with your team, your mortgage broker, and find out if it's something that you can move forward with.
I see. Yeah, so it's a pretty broad conversation. It depends on the needs, obviously.
For sure.
But I think that does give a general idea. I mean, you want... Best case scenario, you want as much income stability as you can. Yes. But worst case scenario, what you're saying is it's always worth the conversation. There's always something we can do. It's just we need to know what you're working with. So
and if there isn't, at least you have the conversation now. So you know, okay, I need 6 months of income, or I need another 12 months. So then in that time, you can focus on making sure that you continue paying your debts, obligations, your credit cards, your cars. If you can pay anything off, that's going to help your affordability, right? Your debt ratios. And then you, of course, can build your down payment.
Right. That makes sense.
Yeah.
Yeah, that makes sense. Because, I mean, there probably always is a strategy if you're willing to pay for it. But I'm assuming, like, even if someone's in a tricky spot already, but they do need a house, like, not in a negative way, but maybe, like we said, they just started a business, but, like, just now, they're not going to have that 2-year history. But I'm sure there's always options, like private lenders or B lenders, that they can use to bridge and then always come back and kind of fix that
with
later,
the B lenders and private, usually you need 20% to 30% down, depending on the property. So, I mean, for a first-time buyer, that's usually out of the question. Most first-time buyers are looking to put 5 to 15% down, depending on what the purchase price is. Yeah. So, if you're looking at that, to come up with another 5 to 15% down payment is quite difficult to do, unless you have maybe some family that can help out. Yeah. So I know most of the time when we're working with first-time buyers, for example, and they need a little bit more time to be able to build their employment history or their down payment, then we just need to work with that. I mean, we typically don't like to position a private acquisition, like acquiring that property privately, because of course your carrying costs are higher. Huge, yeah. Your closing costs, right? There's usually fees associated with private mortgages, so that can really eat at what your down payment is. Right. If there is, of course, above that 20%. Gotcha. Yeah. That I remember when I bought my first house, I was self-employed, just a kind of newer business owner. And it was a bit of a scary process because it's not conventional. Did you work with your bank? I worked with not my bank. I was referred to RBC, an agent at RBC, a specific person at RBC who dealt with self-employed people and small business owners. And it was the best decision because the first 2 people I talked to, one was at my bank and then another was a broker. This is probably we're probably going back 3-4 years now. They kind of it was like, no, this not going to work. The business is too new. It's not going to, we need this, we need that. Went to her at RBC, this agent that I worked with there. And she was like, yeah, no problem. Give me this, give me that. And gave me all these options I didn't even know were there. We did something called, I think it was called something like a stated income mortgage, where she was basically able to take, like you said, the 2 years of business income at a gross level, mix that with my personal kind of take home, what I pull out of that, and then find some average and multiply some weird black magic she did. And the only thing was she needed 30% down, which I did, but she needed 30% down, which I feel like in any lending scenario, the more you have, the easier it gets. The more you can put down, the more it seems like, okay. Well, because there's less risk to the bank, right? Or lesser risk because they have more equity in the property. You're buying their downside, essentially. That would have been there. So that makes sense. And she orchestrated that, and it was super cool. So that's why I know it really does matter. Like in every scenario, it matters who you're talking to, because not everyone knows everything. And especially I think if you're in that scenario of like, hey, I'm self-employed, or I just changed jobs, or I just started a new business, you have to talk to someone who's done that for a client before. Otherwise, they might not know all the options that are available to them, and they might be used to doing something in a very cookie cutter way. And having the relationships with lenders. Again, like we have very strong relationships with our lenders on all sides, right? All categories, which allows us to then run the scenarios by them. But again, when we bring them a deal, they trust that we're already adequating or like underwriting it on our side, so we know what needs to happen. So when we bring them a deal, it's easier for them to say, okay, like we know your files are strong, these are usually good borrowers, what's the problem, here's like what's your proposed solution, and then we work together to make sure that we can get that client the best financing options. Right, like even like one of our trusted lenders, TD, some of the stuff that we can do with them, again, just because we have such a great relationship. Right. Yeah, that does go a long way. And I've learned that too. It's like, especially with brokers, it's who they know. Like I know a couple great brokers in the city, and I know one of them that started, I won't mention names yet, but one started a brokerage relatively recently in the last 2 or 3 years. And his play before he started this brokerage was basically he spent a year or 2 prior literally door knocking every like underwriter at every bank until he could find someone that was like, hey, this is what we're going to do. This is what I'm going to bring you. And he basically got, not in his pocket in an illegal way, but just like in his pocket from a relationship understanding standpoint. He got enough of those in place where they're like, sure, you get clients, you bring them to me, we'll get the deal done, that kind of thing. He got enough of those secured. And when he opened this office for the first time, they blew up. They were super successful because they had a reputation of getting every deal done. And it was because he spent a year or 2 prior to even opening the office just on the relationships, which speaks to how important the lender relationship is. You can't just say I'm a broker now and just start shopping things around. Like the relationship matters more than anything. 100%. It's who you know and how much they trust you. And your process is going to be huge. So I think going with an experienced broker is
I mean, invaluable if you're going to be in real
Absolutely
estate.
It is. And there's a lot of brokerages out there that have 100 agents and they hire new people. And again, it's great to start in the industry. I always tell people that the mortgage industry is one of the best businesses to get into.
Yeah.
But if you're just there and just throwing deals, these lenders see a lot of deals from that brokerage. And again, if the relationship isn't there, it just kind of gets thrown underneath the paper. And now this guy, was it like under the rug stuff, like bad stuff that he was bringing to them? Like maybe that shouldn't be approved? Because again, there's so much of that right now too.
I don't think so.
Okay.
I think it was all pretty. It was just in general. I'm sure some of them were like whatever.
It was just about strong relationships.
Yeah, he had some clients that maybe were stretching a little bit, or maybe they had a lot like job changes, new businesses, that kind of stuff. Stuff that was typically a little harder to kind of make a case for.
Yeah.
People that were maybe getting turned away by other brokerages because they weren't conventional, streamlined. It's not like, yeah, here's my 2 years of income history of working with the city. Like they were more in the air a little bit, especially business owners. I think he had a lot of success with that maybe weren't showing all their income, or they take a lot of cash, or these kinds of deals. He was able to make cases for these kinds of people. And it helped a lot. But I've learned in my real estate career, whether it was buying my family home or the investment side, that relationship with your lenders and your broker is huge.
Absolutely.
Because we do live in a country, either fortunately or unfortunately, where leverage is a necessity. Like you can't really do real estate at scale or even buy your home. Like you're not conventionally, when you see an average family home, 3-4 bedroom, and even a suburb like Bradford still going for 1.4, 1.5 million, that's not something people would just take out of their pocket normally. We live in a country of leverage. And so that leverage is basically gatekept by the brokers and the lenders. And so if you don't have that relationship, you don't have that access to leverage, you really can't do real estate, right? It's so critical. So that's why even I want to have you on the show. And I think it's so interesting is like, really getting to know a good broker, having that relationship, doing deals and transactions with them, building a reputation with lenders that they start to know your name and know your business too. Because even though they know you guys, it's going to be even better once they know, like if I'm an investor and I do a deal with you and we do 3 or 4 deals with the same lender, they start to know me too. And it's the reputation of how I am as an individual, customer.
And your broker represents you just as much as you represent yourself.
100%.
Right? Like so you nailed the head on the coffin.
And I'm sure you guys are kind of picky too, because like you also don't want to bring a client, like you don't want to bring me in and then I default. Like it probably looks bad on you guys too. Like you want to do your due diligence for just your own reputation. You want to bring good clients, right?
And keep that relationship with the lender. I mean, also the capital that they give out, if we're talking about private mortgages, they lend out $1 million on a deal. Typically, I want to go back to them for future deals. And usually private is shorter term, 1 to 3 years. So at some point we want to go back to them and say, hey, we lent you $1 million. They paid out in 1.5 years or 2 years. Now we want to come back and use that $1 million again. Like they want to continue rolling over their
100%.
capital, right? Just as much as we want to keep using their capital. So I think the number one golden rule in private mortgages is, would you lend the money yourself?
Right.
Like that's the thought that you always want to have. So if it's something that you wouldn't do yourself, then you shouldn't bring it to a broker or bring it to a lender.
Right. Yeah. That makes total sense. Makes total sense. No, that's cool. And I mean, it's just there's so much interesting stuff going on. And the problem is, it's such an in-depth conversation too. Like I'm sure we can go into any area for like an hour. But I do want to ask you the one controversial question, the big money question. Where do we think rates are going?
Oh, the big money question. Trying to put a horseshoe or I have no idea. It's a tough question. I mean, over the last couple of years, we've all kind of ate the juice. Whatever you want to.
The Kool-Aid. We drank the Kool-Aid.
I'm kind of bad with sayings. My wife always laughs at me. I make up my own sayings all the time.
We drank the juice.
Yeah.
You're not wrong. We did. We did drink the juice.
So a lot of us did. Right. We were being told that rates were going to stay low for a long time. So variable rates were one of the most popular thing for the last 2 years, previous to last March. But I think mid to late 2024, we'll start seeing rates come down. We've seen the bond market continue to go up. It's at all-time highs, 16 or 18-year highs. So that affects fixed rates. Our Bank of Canada, of course, affects our variable rate mortgages. And I think 2024, maybe mid to late 2024, hopefully, we'll see rates come down. We may see another increase at the end of this month, and that's October.
I'm thinking the same,
I think a lot of people are. Bond market usually prices in what's going to happen. So the bond market's gone up by about 0.5 point, maybe even more in the last month. So that's usually a good indication that rates are going to maybe go up again. I hope not. Prime right now is 7.2. I did put an example of what a mortgage was in 2021. So if you purchased a home in 2021 for 800,000, so I use an investment property.
Okay.
Right. So you're an investor. You buy your first investment property for 800,000. You put 20% down. You have a mortgage of 640. Your prime rate was 2.45% then, and then you got a discount of 50 basis points as an investor. So usually on a residential primary owner occupied, you'd get 0.90% discount. Right. On a rental, it was around 50 basis points, so 0.5. So your rate was 1.95.
Okay.
That monthly payment was $24.05 back in 2021. Okay. So, and then we factor in your property taxes, $340 a month, insurance, $180 a month, and then your monthly rental income, $4,200. So again, I'm from Barrie, typical duplex.
Yeah.
$4,200 is kind of
yeah.
fair.
Yeah.
22 up, $2,000 down. So that means your cash flow is $1,280.
Right.
Cash flow. Now rates are 7.2 prime. So you're then at 6.7. So your monthly payment is now $4,190.
Oof, there goes all your cash flow.
Yeah. So now with all of your expenses, with a $4,200 a month rental income, you're negative $510 a month.
Wow.
Yeah.
And that was the flaw. I used to be involved in a lot of that, duplexes, triplexes, buy and holds, and we got out of it thankfully over the last 2 years.
Yeah.
I didn't know this was coming, but what I started to see was that fear of like, I mean, what you just described is actually like the earlier scenario where you're cash flowing like almost $2,000 a month is a really good scenario, because there was a lot of people out in like Hamilton and those areas like 2-3 years ago. They were overpaying and like they were happy to cash flow $200-300 a month. Yeah. And I always looked at that like, if anything changes in this market, you're screwed. Like you're holding a 7-figure asset to make $300 a month. Like, and anything changes, you go negative. And now you still have this asset and maybe prices come down. It was just, and they're trying to make a business out of that. Like there was this whole trend of people trying to become full-time investors on these $200 a month cash flow properties.
Yeah, it was literally getting thrown around. Everyone was doing
everybody.
Yep.
And it was so dangerous and it was so risky. And then this happened, that scenario you just described.
Yeah.
And those people that were cash flowing $200 only are now like negative $2,000 a month. Right. And I just talked to somebody today on the way here. He had 6 properties. He's now selling at least 5 of them because every single one of them he said he's losing $10,000 a month right now.
That's crazy.
He's negative $10,000 a month. It went from a wonderful cash flowing real estate business to negative $10K a month, right? Which,
does he have a good job to be able to like afford that, or is he like
he's self-employed? I don't want to give away, like I don't want to give you too much because they'll know who he is.
Yeah.
But he's self-employed, so his income is up and down.
So he has the ability to maybe make some more cash.
He does, and so he's basically biting the bullet. But he's talking about selling anywhere from half of the portfolio now to 90% of it.
That's a lot.
To cover the offset, maybe only keeping 1 or 2.
I was just going to say it's unfortunate for him to like bounce back from that, because a lot of investors like they're like, okay, well I'll deleverage right now and then I'll maybe hold some cash. So then when the market comes back, I'll start doing it again. Yeah. And a lot of people are exiting single family or duplexes, even up to fourplexes, because of the financing component. Also, just cash flow. Yeah. Like you said, it used to be $200 to $400 a month. They were like happy about earning. Yeah. And then we got spoiled and everyone was like making $1,500, $2,000 a month in cash flow. If you don't factor in your property taxes and other expenses, you were making like $2,000 a month. Yeah, yeah. So they were getting spoiled with that, and then they get burned. Yeah, I know quite a few people that are deleveraging, and again, you should, if you're in a situation where you have like you're negative $10,000 or anywhere close to that. Yeah, it's scary times. Or imagine if you have an unforeseen expense, furnace breaks.
Yeah, you're done.
Flood. Yeah, whatever the case may be. Like if you're negative $500 a month on that property and you're strapped on your primary residence, meaning you can't afford. Yeah. So that $500 is like really hurting you. And then you have another $2,000 or $3,000 expense land on your table, or someone doesn't pay rent for a couple months. Yeah. And you know, the land tenancy board, like, good luck getting them out.
Oh, it's impossible. We had recently a triplex where someone hasn't paid in almost a year and before we get them out. Stopped paying. We started the process. And by the time we got them out, it was 12 months. Right. Yeah. And so it's, we're not in a country that's very friendly to landlords. It's very tenant focused, which sounds great and fair for you as a tenant, but it's actually not, because it discourages investors, which means if no one's buying these properties to rent out, you as a renter have nowhere to live, and it creates a problem. So it's not great.
But rising rents. Yeah. Right? It affects our rent costs.
100%.
And that's why we've seen, we also see people not being able to qualify for homes. So that factors into the rise in rents.
More renters.
And more people coming to Canada. We can have a conversation about that. But if you're not importing, not importing, but if your immigration is bringing in over a million
small
people,
crates.
yeah, we're not importing people.
Yeah.
But if you're immigrating over 1 million people a year and you're not building enough houses, sure, that affects your rental. But but of course, if your landlords can't get people out, they got to raise rents just to be able to bring in more cash flow.
100%. I mean, that's why I think that the solution to this housing crisis, everyone's focused on the micro of like, oh, the rates or this or no. The solution to this real estate crisis we have, this affordability crisis, this everything, is both sides of the aisle coming together and realizing we need to work together.
100%.
Investors, end users, tenants, they all have to sit together and say, listen, we're in the same boat.
Yep.
If I'm renting, it's because either I don't want to put out a large chunk of capital to buy the house, or I can't. It's one of the two. Yep. Fine. And if I'm an investor, I'm in this to make money. I'm not investing for charity. I'm not investing for fun. I'm investing to make money. And we both have to understand each other. You need a place to live. It's convenient. I'm going to save you capital, and I need to make some money. And in return, we both have to make sure we're comfortable doing that.
Yep.
The problem is we have this like disparity where the landlord and the owner, the investor, is the enemy. Yeah. They're evil because they're making money on housing. Yeah. And the renter is looked at as like this poor renter who we have to support and give them everything they want. The problem with that is policies that cater just to protecting the renter, although sound noble, do what we just said. They hurt the market for the investor. Less people buying, less people renting out creates a big problem. If you don't have the money to buy a house and no one's renting them, where the hell do you live? Like that creates a serious problem. Yep. So we have to be willing to say, no, it's fine. We want investors. We want you, please come make money in housing, make money on rent, because we need you to provide this solution.
Yep.
And if you encourage enough of that, it actually solves itself, because the more investors we have buying property, the more competition, the natural competition there is that will help suppress rents. Yep. The more rental units available, the less pressure on rental pricing, which ultimately is better for that renter, for that tenant. So those tenants need to be actually looking at investors like, no, let's encourage it. Let's work with investors. Let's encourage investing. Let's encourage building of more dedicated rental buildings and units. Let's give tax incentives to people doing multifamily. Let's help more of that happen, because that will A, give us the housing we need, and B, bring down the rental pricing. But that's not happening. Everyone's fighting everybody. Everybody's the enemy. We don't want you to make money. So the renters hate the landlords, and the landlords in a lot of cases now are getting bitter towards the tenants. Yep. You're just living in my house. You're not paying rent. That's not what we need. We need both sides to come together and say, okay, we do need each other. And the moment that can happen, and then policy can reflect that cultural and social change, I think we see real change.
100%.
But we're not there yet.
No,
right?
no. I don't know. Yeah, it's going to take some definitely meddling into both sides, right?
Yeah.
We also need changes in that tenancy board. Like, again, it's, I think, 6 months or even longer to get in and get a court case. And again, that affects both sides. But it also, again, if we have more rentals, if we have a influx of good real estate investors building purpose-built rentals, it allows us to weed out the ones that are the bad ones, right? The ones that are bad or landlords. Yeah. Because there is, right? We all know that. And then there's bad tenants. Yeah. Which
exactly.
Yeah. On both sides. It'll allow it to definitely be a better process.
Yeah. No, 100%. 100%. I mean, the only thing left on my mind here is when it comes to buying real estate right now, I kind of made a bit of a gamble. It's funny because we trade real estate so often, whether it's for clients or it's our investment properties that I'm doing. I don't think twice about it. But when it comes to buying my own home, for some reason, it's always a different feeling. Yeah. I think it's because it doesn't make you any money. Yeah. I just got to spend money to do it. Right. And I know it's not coming back anytime soon. But I did just pull the trigger. We bought a pre-con deal. I don't know if I told you this yet.
No, I don't think so.
We bought a pre-con in Bradford. Okay. It's going to be done in about 12 months or so. Probably going to be pushed, but whatever.
Yeah, it might get pushed.
12 months or so. And everyone's kind of asking me, I get this question a lot of like, why right now? Rates are so high. The mortgages are going to be crazy. You're going to pay, I think like if I put 30% down, the mortgage is like $6,500 a month is the kind of where we're at. And everyone's like, why would you do that? Yeah. And this is a valid question. I want to address it because it's the question of timing. And I asked you before the big question of like, where are rates going? Yep. And so to bring it back to that, I have an opinion on this, and I'm curious on what yours is going to be or what you think of my opinion. But basically, the reason why I'd say you should still buy now, I think if you want to make a move, when you decide that you're going to buy a house, it's also a personal decision. Do you need it? Yep. I need a place for my family, or a growing family. We need more space. I want it in a certain community. We want safety. I want security. At some point, I need to do it. So then I got to think about timing. And we look at where we're at now. It's like, yes, rates are very high. The problem is, it's very hard to catch a falling knife. You don't know exactly when it's going to go the other way. It could be 3 months from now. It could be 10 months from now. It could be 3 years from now. So at some point, you have to bite the bullet and say, if I need to do this, I'm going to do it now. But you still want to be smart. And so the way that I thought of it is like, we're at least in the worst case scenario, I think, and maybe tell me I'm wrong, I think we're somewhere close to the peak. I don't think we go from 7 to 14. Like, I don't think that's happening. I don't think we can go much higher. Maybe we do. Maybe we go 7.5. Maybe we go 8. Maybe we go 9. Oh my God, 9, right? But I don't think it goes much beyond that. And so I think even if you buy now at these high rates, which I think you should do, because right now there's deals, like you said. Mm-hmm. Now people are negotiating. Now people are willing to take a hit. And they're like, you're getting way better deals now, even from builders. Yeah. Like we managed to wrangle a deal from a builder in Bradford less than the starting price of comparable homes up in Georgina.
Yeah. That was my next question is what was the negotiation and what was your purchase price compared to like maybe it's high in 2022?
Yeah.
Right? Like you're getting such a good deal on the house. So yeah,
exactly.
Let's say rates do go down in 6 months. Yeah. That same builder is probably going to increase the price of that home.
Yeah, exactly.
Right? So you're locking that home in now. And if you're going to enjoy it yourself, again, there's a lot of people that are getting into trouble with pre-cons and trying to assign them or sell them before.
Yes.
I don't know if I listen to podcasts all the time, and there's quite a few out there that talk about realtors specifically that talk about situations that they see, especially in the Toronto GTA market, where people are holding like a lot. I don't know if there's one, and I guess the guy bought like maybe 10.
Oh my God.
Pre-con, and he tried to get mortgages on some of them. He's already lost 2, but he can't get mortgages, can't get financing, because that's a problem too. Is are you going to be able to get financing 12 months from now? So I know when you do work with a builder, they usually have a relationship with one of the banks, which they lock in rates typically for the duration of that build, either 1 to 2 years. So it's always a good idea. I always suggest my clients take those offers, because then once 90 days or 120 days out from the closing date, that's when we start shopping around and seeing if I can beat that rate.
Exactly.
And we probably will.
Exactly. That's very cool. Yeah. And I mean, you kind of hit the nail on the head with where I was going to go with that, which is like, we don't know where rates are going to go, but we do know that right now prices are down.
Yes.
We do know prices are suppressed. That's a certainty. We're paying less now than we were 12 months ago.
Yep.
And so you might as well take the thing that's certain, because like the way I've been saying it to clients too is I'm like price is forever. What you paid will always be what you paid, right? Your purchase price won't change after you live in the house.
No.
Your interest rate will.
Yeah.
Interest rates are temporary. So that I think there's that saying that's been floating around. It's not my invention, but I think it was something like you're marrying the price, but you're dating your rates. That's how you got to think about it.
Marry the home, but you date the rate.
There you go. So marry the home, date the rate. Yeah. That's how I think of it. Is like, listen, at the end of the day, we're getting a solid deal. Like this house we're buying, a friend of ours actually bought pre-con 2 minutes away, same area. 2 years ago, we're paying the same they did 2 years ago. And so it's cooled off significantly, because if I did this 6 months ago, we were looking about $200,000 more.
Yeah, that's crazy.
So if I save $200,000, but I eat a rate for like a year, big deal. We know we're somewhere at the peak.
Yep.
But the moment those rates do cool off, guess what's going to happen to pricing again? And you can't undo pricing. No. So if I wait for that beautiful low rate finally to buy a house, but now I'm paying $300,000-$400,000 more, you can't undo that. That's always part of the house. And so I think that's why now is actually a beautiful time. It's a sweet spot. I think if you're trying to buy now, talk to your brokers, your agents, your lenders, get your stuff in order. And I think now is a really good time, because as soon as everyone else catches on, we're cooling off. That's the last rate hike. Everyone's going to rush again at the same time. Prices are going to drive up again, and you miss the boat. Yeah.
So and you know better than anyone, realtors do drive the market. So when rates go up, when rates do go down, there's going to be an influx of people coming back to the market, because everyone's going to reach out to their database and saying rates are down. Like, now you need to buy, which people are doing now, right? People are saying rates are high, but prices are down. They're having the same conversation, but it's going to go the other way as soon as rates come down. And I think we all know that, right? All of us see things, and you can see history that when rates come down, prices come back up. I mean, it is nice that we have seen a little bit of a correction. The market in Canada in specifically has just been nuts over the last 3 years, and so we did need to see a little bit of it. We needed it. It was getting crazy and unaffordable for a lot of people. And unfortunately, it is still unaffordable. And the only thing we can say is that we just need to try and work with it. If home ownership is in your future goals, then we just need to figure out a plan to get you there. I mean, there's always ways to increase your income.
100%.
Because that's the number one factor: income and down payment, and of course your credit. But there is always things that you can do. Right?
And I think more people will have to be willing to also share space. I think you have to, hey, can I go in with my brother and his wife, and we can split this house up, live there for 2 years, make some money, and then we can go our separate ways.
Yeah.
I think more families, and that's what you see a lot more in Europe. You see families living together, parents, siblings, brothers, sisters, friends. It's more common.
Yep.
Here, we're kind of stuck on the idea of this isolated home ownership, my home for me. But when you get to the prices we're at, that might not be reasonable, especially for a first-time buyer.
Yeah.
And if you can pool 4 incomes instead of 2, it makes it a lot easier. Yep. Right. And so I think that's something people have to look at too, one way or the other. But either which way, I think the next 3 to 6 months is a really good time to get in. And I think pre-con is more attractive now than ever, because you're arbitraging that rate. You're locking in the purchase price. You're getting the thing today that's good, which is the purchase price, but you don't actually have to like absorb that rate and those payments for potentially 12 months, 24 months, 3 years. Like some of the condos we sell through here, my brokerage, we do a lot of pre-con. Some of these condos are 3 to 4 years out. Right. So you're locking in pricing today, but you're not actually going to pay a mortgage for 3 to 4 years. Right. And you're hoping in 4 years we've come back to something more normal. Right.
Yeah, and hopefully prices have came up. I mean, that's always the hopeful goal, right? In any pre-con is that prices have came up and you're going to get a good buy. Exactly. And then you of course get a good rate at that time. In hopes, right?
100%. So I think it's a great time for pre-con, whether you're buying your home or you're doing an investment. But either which way, I think now is a really good spot, because once we miss this window, who knows when the next time is. Like we might climb. We might climb for another 3 years, 5 years, 10 years. Like we don't know what the next cycle looks like. We just know right now it's slow. And man, sellers are flexible. Let's put it that way.
Yeah, it's definitely a time to negotiate. Like
buyer's market.
So many different terms. I don't know if you saw that one podcast, Daniel Foch, he was or not just a podcast, but he posted it. How VTBs, I think you mentioned, we were talking about that, weren't we? Or was that someone else?
Yeah.
VTBs are at the highest they've ever been.
Oh, yeah.
Sellers are offering VTBs.
For investors, 100%.
Investors, or even if it's going to be a primary, it's tougher to like add that financing into a primary or owner occupied, but there is ways that you can do it.
For sure.
The other thing, again, something just slipped my mind, but yeah, negotiation right now to get a good deal is definitely there. Yeah. It's a buyer's market.
You have a lot of option, and it's crazy. Like when you look at most listings now, like sold listings, especially our like Simcoe County, most stuff's selling under ask.
Yes.
And so people have, there's room. You have lots of conditions. You can get your closing terms that you want. You can do everything that you need to do now. You can do, which you couldn't do last year. You couldn't even barely get financing conditions last year.
Yeah, or more so like the end of 2021 and beginning of 2022.
That's what I meant. Yeah. By the way, COVID wiped my brain, so I have a missing year.
Me too.
everything was 2 years ago.
Yeah. I feel
feels
like
last year.
I feel because sometimes people ask how long you been a mortgage broker. I'm like, 4 or 5 years. It's like 3.5 years, but
it's a time warp.
It was crazy busy. I mean, even for you guys during that time, it's nuts. I know you sold a business and stuff, but you've been heavily invested in real estate. So
I sold a marketing biz in that time, so that kept me busy, and then I kind of went all in on real estate now, which has been, I think it's a bittersweet thing, because like we said, the market's kind of weird, but at the same time, it's great. I'm learning a lot more. We're getting more creative. My skills actually are coming into play now, because before, every agent could just like put up a listing and it sells. Now they need to actually market, position, brand. How do we promote? And most agents don't know how to do that. So it's given me such an edge to take like the marketing agency world and bring that into real estate. And now is the time that was needed more than ever. So like it couldn't 100%. Have worked out better.
Yeah, I agree.
So thank you for bringing that up. But that was a fun, selling last year was a big thing. So I'm glad I did. I'm glad I'm in real estate now. I can work with great people like you and do more deals and do fun stuff like this podcast. Cool, man. Well, thank you so much for taking the time to actually come out and do this.
My pleasure.
I think it was helpful. Is there anything else you want to leave everyone with on a last final note?
I don't think so. I mean, we touched on so many good topics. I think the biggest thing is if you have any questions, reach out to yourself or me. I mean, we're always great spots to be able to seek advice and kind of point you in the right direction. So I think that would be the biggest thing, is just be open to having those conversations, hard or good, whatever they are. If you're going through hard times, definitely reach out to a broker to figure out what kind of the best solution is. And then of course we work with realtors to figure out if there's a good option to sell. Just
100%.
I think that's the biggest thing.
I think that's a great point to end on. I mean, conversations have to be had. Absolutely. And I think a lot of people are too afraid to take the first step. They have all these misconceptions in their mind. They're in an echo chamber basically, and they're afraid to reach out until they think everything is perfect. But that's not what it's got to be. They got to just reach out, talk to your real estate agent, talk to your mortgage broker, start telling them what you're thinking, tell them where you're at, because together we can come up with a plan. And no conversation is not worth having. I think every broker agent is happy to just have the conversation, see where we can help, and help you figure out your plan. Whether you're an investor, you're like, hey, I have this portfolio, I'm trying to figure out how to make these payments work. Is there a refinancing option? Should I sell half? What should I do? Or you're trying to grow, or you're just a first-time house buyer. Whatever it is, whatever situation you're in, you should be, as soon as you get that like thought of, I have to be buying or selling anything right now, have the conversations.
Absolutely.
Talk to the right professionals. Don't be afraid to reach out.
Our advice is free, right?
Exactly.
I don't charge anyone for anything until I close a mortgage. And then again, most of the time the payment's coming from the bank. So advice is free. The other thing, you mentioned real estate investors. For them, it's even a great time to buy right now. So if you are real estate investors and you're sitting on the sideline, you're thinking is now a good time. Again, negotiation right now is in your favor. Yeah. It is a buyer's market. So if you can cash flow a property right now at the peak of rates, as we said, we're probably there, then when rates do come back down, you'll be able to cash flow even more. Or if your exit strategy is to sell that home in a couple of years after maybe you do some updates to it, you're going to see an influx in that value potentially, right?
Agreed.
As rates go down.
So many sellers that are liquidating portfolios now that need the money and will take discounts, like heavy discounts. So it's a great time to buy. If you have the position and you have the liquidity to do it and the right brokers to get you the money, then it's a great time to do it. I agree, man.
Yeah. So I just leave it on that, I guess.
Beautiful.
Yeah, I think that's great.
Where can people find you?
Of course, on Instagram, Action Jackson -20, I think.
Yeah.
It's funny. I've had that handle.
We'll drop it somewhere below.
DonaldsonCapital.com. And then Jack at DonaldsonCapital.com is my email address. But yeah, anytime. I really enjoyed coming on today.
Awesome. Thanks for coming on, man. I had a great time.
Yeah, me too.
Talk to you next time.
Absolutely.
Thanks for tuning in to another episode of Inside Canadian Real Estate, guys. Don't forget, if you liked the episode, if you found it enjoyable, if you learned something, if you liked our guest, if you liked our topics, don't forget to subscribe to Inside Canadian Real Estate on Instagram. That's where you'll find all of our clips posted. We're also sharing on YouTube, so just search Inside Canadian Real Estate on YouTube. Follow along, and please, 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 if you really want to help the show, because again, there's not a lot of Canadian content on real estate. We're putting a lot of money and time into this. If you really want to help us expand, don't forget, subscribe to the show on wherever you're listening to your podcast. Leave a review if you can, whether it's on Apple Podcasts or Google Podcasts, Spotify. Subscribe to the show, follow the show. Don't forget to leave that review. And please, if you found it useful, share it with somebody. Share it with a friend. We don't charge you for the show. We don't run any ads. All I ask is you share it and help us get the word out. Thanks again, guys.